China built ghost cities bigger than Manhattan, poured $4 trillion into concrete and steel, and created the world's fastest economic boom. But beneath the skyline, an $8 trillion debt bubble swelled in the shadows, fueling growth no one dared question. Now property giants are collapsing, millions face unfinished homes, and global markets are on edge. What triggered the hidden collapse? And who will pay the price when China's debt machine finally breaks? In late 2008, as the world reeled from the financial crisis, China's leaders unleashed a stimulus package worth 4 trillion yuan, more than $500 billion at the time. The plan was bold. Pour money into new highways, high-speed rail, airports, and housing all at once. Within months, construction cranes filled city skylines from Guangzhou to Harbin. Factories ramped up steel and cement production. Local governments, eager to join the boom, scrambled to launch their own mega projects, often borrowing heavily to do so. The surge in credit was immediate and massive. China's total social financing, a broad measure of all loans and bonds, jumped from 62 trillion yuan in 2008 to 100 trillion by 2012. By 2013, the pace of new credit creation rivaled the GDP of entire G7 countries. Animated charts from the period show a sharp spike, as bank lending, corporate bonds, and trust loans all soared in tandem. For many officials, the new mantra was simple: growth at any cost. This flood of easy money powered double-digit GDP growth and created jobs for tens of millions. But the money didn't just build roads and bridges. It also poured into real estate, fueling a building spree that reshaped city skylines and gave rise to entire districts with few residents. Local governments leaned on land sales to developers as a primary source of income, deepening their reliance on the property market. The initial burst of stimulus set off a chain reaction, embedding debt deep within China's economic engine and tying local prosperity to the fate of construction and land finance. Local governments in China face a unique fiscal challenge. Unlike national authorities, they have limited power to raise taxes, so they turn to the land beneath their feet. By selling land use rights to property developers, city and provincial officials unlocked a powerful revenue stream. At the height of the boom, these land sales made up as much as 40% of local government budgets, sometimes even more in fast-growing regions. The process was simple on paper. Government-owned land was auctioned to the highest bidder, developers paid up front, and the proceeds funded everything from schools and hospitals to new subway lines. But the system carried hidden risks. As cities expanded and demand for new apartments soared, officials had every incentive to keep selling land, often at ever higher prices. This created a feedback loop. More land sales meant more revenue, which funded more infrastructure, which boosted property values, leading to even greater demand for land. Local government financing vehicles, state-owned companies created by city officials, borrowed against future land sales, taking on debt to back new projects. The result was a cycle where growth depended on a steady stream of successful land auctions and rising property prices. Fiscal studies show that when nearly half of a city's budget relies on land sales, any slowdown in property demand can punch a hole in public finances. The land sale model rewarded overbuilding and speculation, leaving local governments exposed if the property market ever faltered. As the next section reveals, this dependence would become a key vulnerability when credit tightened and real estate demand began to wane. Hidden debt in China is not a single number, but a vast network of obligations woven through the country's financial system. The $8 trillion figure, cited by the IMF and World Bank, combines layers of off-the-books borrowing that sit outside official government statistics. At the heart of this system are local government financing vehicles, or LGFVS. These are companies set up by city and provincial authorities designed to raise money for infrastructure and development projects that local budgets can't legally support. LGFVS borrow by issuing bonds, taking out bank loans, and tapping shadow banking channels. On paper, they are separate from local governments, but in practice, their debts are widely seen as carrying an implicit government guarantee. Estimates put LGFV debt at between $5 and $6 trillion, by far the largest share of China's hidden liabilities. The rest comes from property developers' short-term borrowings, trust loans, wealth management products, and a maze of supplier IOUs and off-balance sheet obligations. Much of this debt is structured to bypass formal restrictions, using complex legal entities and creative accounting. For example, a city might create multiple LGFVs, each raising funds through different channels, then shuffle assets and liabilities between them to keep borrowing off the books. The result is a financial web where money flows from household savings into high-yield wealth management products, through banks and trust companies, and finally into LGFVs and real estate projects. Many of these loans are short-term, while the projects they fund, roads, subways, housing, take years to complete and generate returns. This mismatch leaves the system fragile, especially when property sales slow or land values fall. In some provinces, LGFV debt now exceeds the entire annual economic output of the region. The true scale is hard to pin down, with official Ministry of Finance figures showing 14 trillion yuan in hidden local debt. But outside analysts estimate the real number could be 4 times higher. What is clear is that China's $8 trillion debt machine is both vast and opaque, powered by local governments' need for growth and the financial system's willingness to supply easy credit. Short-term funding and long-term projects rarely mix well. In China's debt machine, this mismatch became the rule, not the exception. Local government financing vehicles borrowed money on a rolling short-term basis, sometimes just months at a time, while the roads, subways, and apartment blocks they built would take years to finish and even longer to generate returns. Developers, too, leaned heavily on short-term loans and wealth management products to fund sprawling construction schedules. The result? A constant need to refinance, always searching for the next round of cash before the last one ran dry. This cycle left the entire system exposed to any sudden change in market sentiment. If property sales slowed, or if banks hesitated to roll over loans, the funding chain could snap. In some provinces, the value of maturing local government financing vehicle debt now rivals the size of the local economy itself. Analysts tracking bond prospectuses and People's Bank of China filings have flagged that a growing share of these obligations are coming due within the next 2 years, raising the risk of missed payments or forced asset sales. In August 2020, Chinese regulators tried to rein in runaway borrowing with the introduction of the so-called 3 red lines policy. For the first time, developers faced hard limits: an asset-to-liability ratio capped at 70%, net gearing below 100%, and enough cash on hand to cover all short-term debt. These thresholds were not suggestions. They were enforced quarterly, with access to new borrowing strictly limited for those who breached any line. The People's Bank of China and Ministry of Finance circulated these rules to major firms and lenders, signaling a new era of discipline. Many of the country's largest developers immediately failed at least one test. Evergrande, for instance, breached all 3. As credit shut off, companies were forced to dump assets, halt projects, or default outright. The policy's abruptness left little time to adjust, exposing the fragile foundation beneath years of easy money. In the months that followed, unfinished towers and unpaid contractors became common sights, and the system's vulnerability was laid bare. The mechanics that once fueled growth now threatened to unravel the entire model. Evergrande's story began with a rapid ascent and ended in a courtroom order for liquidation. Founded in 1996 by Xu Jiayin, the company grew into China's largest property developer by leveraging relationships with local officials and borrowing aggressively. By 2021, Evergrande's liabilities had swollen to around $300 billion, making it the world's most indebted real estate firm. The company's expansion wasn't limited to housing. It pushed into electric vehicles, healthcare, and even soccer, all funded by a constant stream of new loans, bond issuances, and high-yield wealth management products sold to ordinary citizens. For years, Evergrande's balance sheets painted a picture of relentless growth, but much of its reported revenue was later found to be inflated. In 2019 and 2020, Chinese regulators uncovered that Evergrande had overstated its revenues by more than $60 billion, using early recognition of pre-sales and creative accounting to mask a deepening cash crunch. The real pressure came in August 2020, when Beijing's three red lines policy cut off access to new borrowing for firms that breached strict leverage limits. Evergrande failed all three tests. Suddenly, the company could no longer roll over its massive short-term debts. Construction sites stalled, suppliers and contractors went unpaid. Home buyers who had put down deposits for unfinished apartments found themselves in limbo. In September 2021, Evergrande defaulted on offshore bond payments, triggering cross-defaults and a cascade of missed obligations. The company's shares were suspended on the Hong Kong Stock Exchange. Executives raced to sell assets, but most were already pledged as collateral to mainland banks. By early 2024, Evergrande's options had run out. On January 29th, a Hong Kong court ordered the company's liquidation, appointing Alvarez and Marsal as liquidators. Over 90% of Evergrande's assets had already been seized or pledged, leaving little for foreign creditors. Regulators fined the company $579 million for financial misconduct, and top executives faced criminal investigations. The collapse of Evergrande made the scale of systemic risk painfully clear. A single company's downfall sent shockwaves through financial markets, local government finances, and the lives of millions of ordinary Chinese citizens. The fallout would soon spill beyond balance sheets, as unfinished homes and unpaid wages ignited a wave of social unrest. Across more than 100 cities, a new kind of protest took hold. Homebuyers, who had spent years saving for a place of their own, found themselves locked into mortgages for apartments that would never be finished. By mid-2022, over 320 property projects faced organized mortgage boycotts. Families in provinces from Jiangxi to Hunan refused to make payments on homes that remained empty shells, their frustration spreading quickly through social media groups and chat apps. The sense of betrayal ran deep. Deposits were gone, construction had stopped, and developers offered only vague promises or silence. The fallout rippled far beyond these buyers. Contractors and suppliers, owed months of back pay, began to shutter their workshops or lay off workers. By late 2023, unpaid bills to suppliers and builders had climbed past 1.7 trillion yuan, over $240 billion. Many small firms, especially in China's northeast and inland regions, faced bankruptcy. Migrant laborers who had traveled hundreds of miles to work on these sites returned home without wages. Across the supply chain, anxiety turned to anger, fueling protests outside government offices and developer headquarters. Country Garden, once seen as a safer bet than Evergrande, also stumbled. The company missed payments to thousands of contractors, leaving towers half-built and local economies reeling. In some cities, entire neighborhoods stood silent, their unfinished facades a daily reminder of broken promises. The strain reached peer groups as buyers and suppliers watched friends and colleagues swept up in the same crisis. Each new default or delayed project deepened the sense of uncertainty, making it harder for anyone to trust that their investment or their job was safe. This wave of unrest wasn't just about money. It was about shattered confidence in the very system that had promised prosperity through property. As more people joined boycotts and as supplier arrears mounted, the risks spread, threatening not just developers but local governments, banks, and the social fabric itself. Iron ore once filled the holds of bulk carriers bound for China, fueling a construction boom that seemed unstoppable. In 2023, though, the tide turned. Chinese customs data showed iron ore imports dropped nearly 8% compared to the previous year, the steepest decline in over a decade. The slowdown wasn't limited to iron ore. Copper, aluminum, and even cement shipments shrank as stalled property projects and local government cutbacks rippled outward. For countries like Australia and Brazil, which had grown accustomed to surging demand from Chinese steel mills and concrete plants, the impact was immediate. In Western Australia's Pilbara region, miners reported layoffs and idled equipment as export volumes slipped. Brazilian ports, once crowded with ore carriers, saw fewer vessels anchoring offshore. South Africa, Indonesia, and parts of West Africa also felt the pullback, as Chinese buyers renegotiated contracts or canceled orders outright. Commodity markets reacted quickly. Global iron ore prices, which had hovered above $130 a ton in early 2022, slid below $100 by the end of 2023. Steelmakers in China ran at reduced capacity, and inventories of unsold rebar and sheet metal piled up in warehouses from Tianjin to Guangzhou. The shock extended to oil and coal as construction slowdowns meant less diesel for trucks and less power needed for cranes and mixers. For resource-dependent economies, the drop in Chinese demand translated into budget shortfalls, weaker currencies, and lost jobs. The world's largest consumer of raw materials had hit the brakes, and the effects rippled far beyond its borders. Credit markets have become a global barometer for China's property and local government debt crisis. In late 2023, 5-year credit default swap spreads on leading Chinese property bonds soared to levels rarely seen outside sovereign defaults, peaking at 4,000 to 5,000 basis points. For investors, these numbers signaled that default was not just possible, but likely. Offshore bondholders, especially those holding Evergrande, Kaisa, or Sunac notes, faced losses of a scale almost without precedent. Restructuring plans offered recoveries as low as 5 to 18 cents on the dollar, translating to haircuts of 80 to 92%. Most payouts were delayed, tied to new long-dated notes or speculative equity, leaving foreign creditors with little real recourse. This wave of losses rippled through global funds and raised borrowing costs for Asian and emerging market issuers far beyond China's borders. As risk premiums climbed, capital fled regional bond markets, and new issuance ground to a halt. Policy responses in Beijing took shape under mounting pressure. In October 2024, the Ministry of Finance announced a refinancing program worth over 10 trillion yuan, about $1.4 trillion, aimed at rolling over maturing local government and LGFV debt. The bulk of this would be deployed through 2025, with 8 trillion yuan earmarked for swapping opaque local bonds into longer-term, more transparent obligations. Officials describe the program as a firewall against systemic risk. But most of the new funds simply replace old debt, buying time rather than resolving the underlying solvency problem. Analysts warn that unless unviable projects are written down and losses recognized, the cycle of refinancing will only deepen the sense of unease. The central government's willingness to backstop local debt has reassured some investors, but the sheer size of the program is unprecedented for a middle-income country. The question now is whether these measures will restore confidence or just postpone a reckoning. In 2023, China's hidden local government debt reached an estimated $8 trillion, according to IMF and World Bank reports. This crisis is rooted in a post-2008 model where up to 40% of local government revenue came from land sales and off-balance sheet borrowing through local government financing vehicles. The collapse of Evergrande, with over $300 billion in liabilities and a court-ordered liquidation in January 2024, exposed the system's fragility. Millions of homeowners and contractors remain affected, and over 320 property projects have stalled. Despite policy interventions such as the 3 red lines in 2020 and a planned 10 trillion RMB refinancing program, the full scale and location of hidden debt are not publicly disclosed. What remains unclear is how Chinese authorities will manage the next wave of maturities. One fact is certain: as China's debt crisis ripples through commodities and global credit markets, the economic stability of many countries is now tied to these unresolved risks.